Almost every pound in the economy was never printed by a government. It was created by a private bank on a computer the moment someone borrowed. 97% of the money in circulation is not cash, it is bank deposits, numbers sitting in accounts. Only 3% is the physical notes and coins in your pocket. The rest is made by lending. The picture in most heads is a bucket. Savers pour money in, the bank holds it, borrowers scoop it back out, and the bank earns the gap between the two rates. That is the story in the textbooks. It is also the wrong way round. When a bank grants a loan, it does not hand over money it was keeping for someone else. It writes a new number into the borrower's account. Two entries appear in the same instant: a loan the borrower now owes the bank, and a deposit the bank now owes the borrower. Both sides of the balance sheet grow together out of nothing. The money did not exist a second earlier. The Bank of England describes it plainly. Whenever a bank makes a loan, it creates a matching deposit and new money with it, money made at the stroke of a banker's pen. Your bank balance is not a stack of cash in a drawer with your name on it. It is a record of what the bank owes you, a liability of the bank. In the Bank of England's words, not an asset it could lend out. Saving more does not hand banks more to lend. The deposit and the loan are born in the same entry, at the same moment. For a century, this was argued and never actually tested. In 2014, an economist took out a real loan from a cooperating bank and watched its internal books as the money arrived. Nothing moved in from another account, inside the bank or out. The bank created the funds by crediting the account, the first empirical proof that a single bank creates money out of nothing. The textbook explains the rest with a chain. The central bank injects reserves. A bank keeps a fraction, lends the rest, that gets re-deposited and lent again, multiplying up into many times the original sum. A fixed reserve ratio sets the ceiling. It is tidy, it is famous, and the central bank that studies it says it is not an accurate description of how money is created in reality. The causation runs the other way. Banks lend first, creating the deposits, and obtain whatever reserves they need afterward. Reserves follow lending, they do not drive it. The multiplier is not off by a factor, its arrow points backward. The rule everyone is taught, banks keep 10% and lend the rest, describes a reserve requirement the United Kingdom does not even have. There is no ratio. There is no fixed fraction held back. The number is 0. If banks conjure money by lending, something has to stop them making it endless. It is not a vault running dry. The brakes are competition and profit, the risk that any loan defaults, and capital rules that force a bank to hold real equity against what it lends. Those are the constraints that bind. Capital and demand, not a bucket of reserves. Above all of them sits one lever. The central bank does not ration how much money exists. It sets the price of borrowing, the interest rate, and lets that decide how much households and firms want to borrow. Move the price up, lending contracts. Move it down, lending expands. The quantity of money is an outcome. The price is the control. There are two kinds of money on two levels that never touch. On top, the deposits everyone uses to pay for things. Underneath, reserves, accounts that commercial banks hold at the central bank, used only to settle payments with each other. A wall runs between the two floors. You have never held a reserve, and you never will. Reserves are the plumbing between banks, an IOU from the central bank to the banks alone. They cannot be lent down to the public, because the public has no reserve account to receive them. Quantitative easing is usually reported as the central bank printing money and handing it to the economy. It is an asset swap. The central bank buys bonds, mostly from pension funds and insurers, and pays with new reserves for the seller's bank and a new deposit for the seller. A government bond becomes money in a pension fund's account. 3 balance sheets move at once, and a bond leaves the world as new money enters it. Those new reserves do not get multiplied out into loans across the system. The central bank rejects that directly. They sit in the interbank layer, unable to cross into the shops, and it is not free money for the banks. Every reserve arrives paired with a new deposit the bank now owes its customer and pays interest on. Its work is to lift asset prices and lower borrowing costs, pushing private spending directly, going around the banks, not through them. Creation runs in reverse as well. Repay a loan, and the deposit and the debt cancel and vanish together. The money is not carried into the bank's vault. it stops existing. Pay off a credit card bill, and the money you used is simply gone from the world, uncreated the same way it was made. Money and debt are two sides of a single accounting entry. The supply grows only when new lending outruns repayment. If a country paid down every loan at once, most of its money would disappear along with the debt. There are two makers. The central bank creates base money, the cash and the reserves. Commercial banks create the broad money everyone actually spends by lending. Base money is roughly 3% of the total. The other 97% is made and unmade by ordinary banks deciding whether or not to lend. Money is not a stock of things dug out of the ground and handed round. It is a promise recorded twice, an asset for the lender, a liability for the borrower, written into existence when a bank lends and erased when the loan is repaid. Nearly all of it is made this way by private banks as debt. The only real limits are the price the central bank sets and the risk the banks are willing to carry.